Welcome to the Investing for Beginners podcast. We have a special guest for you today, Nick Maggiulli. He joined us before and he is joining us again, COO of Ritholtz Wealth Management. I personally love all of his charts and the data that he brings, but he's so much more than just the data, and you will see that in this conversation today. So Nick, thank you for joining us today. Excited to talk about markets and finances and all that fun stuff.
Yeah, thanks for having me back on again.
So what's your take on, obviously a scary economic climate might scare some people off from thinking about the stock market. What is your take on all that, and how should investors react, if at all?
I mean, if you're a student of history, these things have happened and worse things have happened. Scarier economic times have happened, and the United States has gone through it. That doesn't mean that there can't be extended periods of market declines. All the stuff, the volatility that started in April with all the tariffs and all that, I don't think that's over completely. Obviously, the market has kind of recovered a bit since then, but in terms of what's going to happen next, who knows? And even then, we're filming this ahead of time, and by the time it gets released, the environment could be different as well. So how I kind of counteract that stuff is I just, history a little bit, these types of things happen. I wish they didn't happen, but they do. And so given that, you just got to prepare yourself mentally for these types of events. And, and my philosophy, it really doesn't change. I just keep buying, and I really mean that. So I'm not just trying to plug my own stuff, but that's literally what I've done since 2012. And I've not sold an investment besides some individual stocks. I've literally just, and some basic rebalancing, I've just been buying over time. So.
Yeah. Can you recap that for us? Sounds super simple, not always as simple to execute because we can talk ourselves out of a million great ideas. So why just keep buying? Why have that confidence in the market?
I mean, if you look, and this is not just the US market, because some will say, hey, US stocks were an outlier. We're technically not the best stock market, in let's say recent decades, but we're top three. I think the only ones that are better are South Africa and Australia. Australia hasn't had a recession or something, a few decades or something like that. So there are a few that have beaten us, but just a generally well-diversified portfolio of income-producing assets purchased over time is going to build wealth. It has historically. I don't doubt that in the future. It won't build wealth as quickly as just U.S. stocks have, I don't think. And of course, that trend could reverse in U.S. stocks, which is why you're diversified. So even if there is a lull in U.S. stocks, maybe this is the beginning of that period, who knows? You have other assets that are generating value over time. So the mantra in my first book, Just Keep Buying, is the continual purchase of a diverse set of income producing assets. That, I think, if I knew nothing about you and I had to give you one piece of advice to build wealth, that's what I would tell you to do, right? I would just give you that mantra, and it's all in there. Continual purchase, keep buying over time, diverse set, there's the diversification element. And what are you buying? Income producing assets. That doesn't mean you can't own some gold, you can't own some Bitcoin, you can't own some art, whatever. But I think that should be a minority of your portfolio. So 85 to 95% of your portfolio should be income producing assets, which are things like stocks, bonds, real estate, private businesses, whatever it is. There's farmland. There's a lot of different ways you can do this, and I don't think there's a right way of doing it, but whatever fits you and your profile and your risk profile, the types of investments you like. Some people like the tangibility of real estate, whatever it is, just find those things and keep buying them over time.
Does that advice change depending on where you are? Let's say you're fresh out of college, or you're having kids, or maybe you're empty nester. How does that kind of shift happen with the mindset and everything?
I don't think the mindset changes. I think the allocation might have to change. And so usually, the typical advice is, you do whatever, 100 minus your age, or 110 minus your age, and that's your stock allocation, your allocation to equities. So if let's do 100 just to make the math easier, 100 minus your age, let's say you're 25, then means you should be 75% stocks, right? If you're doing 110 minus your age, then you're 85% stocks, right? And then you just slowly taper it down over time. That's the typical advice. I don't necessarily agree with that. I think your portfolio should also kind of match your liabilities a bit. So if you have, for example, if you are, in your 30s and you're a couple and you don't plan on having kids, I think you can take more risk than if you're in your 30s and you have 4 kids, for example, right? So I think the type of risk you take and the amount. There's different ways of doing this. You can just have it all in one portfolio, or you can just have a bigger emergency fund and your portfolio has the same level of risk that you would have had regardless of your liabilities. But I think adjusting for your liabilities is the way to kind of set your asset allocation.
Makes sense. I mean, personal finance is so personal, right?
Yeah.
Risk tolerance kind of play into that too, like depending on people's personalities, you think?
Of course, yeah. So this was, adjusting for different risk tolerances. So it's like assuming the same person with the same risk tolerance, I still think there should be like an adjustment based on the number of liabilities you have, right? So that's all else equal. But yeah, of course, all those things are going to matter, and how you reacted in 2020, how you reacted in 2022, how you reacted in April of this year are all going to be very informative for the type of portfolio you might want to have. If you are panicking when the market is down 20%, that probably means you have too much in equities and you're not going to be able to hold when the market's actually down 40 or 50 or more, because that has happened historically, and I can almost guarantee it's going to happen again. I don't know why, and I hope it doesn't, but it probably will happen at some point. And when it does, that's where people can really make decisions that end up losing them a lot of money.
Does the allocation between like individual stocks versus an index change that calculus at all? You mentioned you had some individual stocks that you sold out of. If you want to share about those, that's cool too. But does that kind of change, or should that not matter?
I think the overall allocation to equities, that shouldn't matter all that much. In my opinion, I kind of look at individual stocks as kind of more undiversified bets, and there's nothing wrong with them. I just think there's a lot of reasons why I don't do them, and I can tell you about my reasons. Like I've gone through different phases of like why I didn't buy individual stocks. The first one was like the performance argument, like, hey, you're probably going to underperform an index. Most people know this one already. It's the dead horse that's been beaten, so to speak, in terms of the anti-stock picking movement. The second one, which is the second argument, is the one I put forth in Just Keep Buying, and that was the existential argument, which is, how do you know if you're good at stock picking, right? Like if me and LeBron James went and played basketball right now, like it would be very obvious within not even 5 minutes that he has talent and I don't, even if you didn't know who LeBron James was. You know what I mean? Like you can pick up, you can recognize talent in certain industries very easily. If me and some other person went and picked stocks, you wouldn't know who's skilled for maybe a year. And even if I was more skilled, they could have just gotten lucky, right? It might take a decade or longer before you had just absolute proof that one person was skilled and one wasn't, right? So I think that's the second argument I put forth. And the third one, which is the final one, is just the mental freedom. I don't spend any of my time thinking about individual stocks, because when I own them, I spent so much time looking at them, even if they were like 1% of my portfolio. Like the S&P could be down, 3-4% on the day. And in terms of my absolute wealth, that's impacting my wealth a lot more, but I'm still focused on this little 1% position that I kind of bought because I think you identify with it. You're like, I made a choice that was not the default choice, which is an index fund. And so because of that, I focus so much on it. So now that I've gotten rid of all those positions, I don't have any individual type positions like that. All I have is, diversified index funds. I don't worry about that at all. And so that mental freedom I have allows me to go do other things, do research, write blog posts, write books, etc. Like it just takes so much, that stuff can take so much of your time, your mental time, and I don't spend any of my mental time on those things. And I think it's benefited me as a result.
It's funny how the brain can work like that. Like logically you're down, but because your 1% stock is higher, you're stoked about it.
Yeah,
it's
exactly.
It's a funny idea. Yeah. So kind of going back to the whole liabilities thing, where did you come up with that idea? That's such an interesting, I mean, it makes complete sense, but I don't think I've heard much about people like directly tying risk tolerance to liabilities.
I mean, there's a lot of different ways you can do it. I think the original thinking, which I haven't written about on as much, I've written about a little bit, was based on like, maybe your allocation shouldn't be based on like things that have nothing, like, not, I don't say nothing to do with you, but like your age is not something that has anything to do with your risk tolerance or your ability to take risk. Like there's something there. I'm not going to say it's absolutely nothing, but there's something there, but it's not individualized to you. Like everyone, there's a bunch of 30-year-olds in a room. They probably have many different things that are impacting their financial profile, and their age is probably one of the least important. It matters definitely, but it's one of the least important. So the thinking was, well, okay, let's say you're in the oil and gas industry. Maybe you shouldn't own oil and gas stocks. Your income's already exposed to that, right? So that was like the thinking. Okay, if I'm in the financial services industry, if I'm a partner at a wealth management firm and I have equity in that firm, should I also be taking as much stock risk as I'm taking, right? That's a question, right? And then, oh, if I also have four mouths I need to feed, like, is that, you start running through these questions. And once you start to go through this, you can say, okay, maybe I should change my risk profile based on my actual life and me specifically, instead of just saying, oh, I'm 30 years old, I should be 70% equities, right? That's the typical advice that's out there, and there's just no thought put into it. It's because it's a simple math formula, and I don't agree with that. I think you have to change kind of your advice based on what you know about a person, right? And so, like, in my next book, which is coming out, The Wealth Ladder, that's exactly kind of what I'm talking about. And that one piece of information I get from you is just your current wealth. Like, how much, what's your net worth right now? Like, you take all your assets minus all your liabilities. So that includes, like, your assets going to be, your car, your home, your stocks, your cash, etc., minus your liabilities, mortgage, debt, credit card, whatever. You get your net worth, right? And you don't even have to have exactly your net worth, because, the wealth ladder has 6 levels and there's different ranges, and some of them are pretty large. And so once you just know what level you're in, I can kind of say, okay, now I know you're in level 1, which is less than $10,000. Here's what I would recommend. If I know you're in level 2, which is $10,000 to $100,000 in wealth, here's what I'd recommend, etc. So I think the idea behind a lot of this stuff is to think about, how does the advice change based on your current situation? I think your strategy should change over time. It's very easy to say, hey, just use this one strategy forever, but I realized it was, like, not perfect. It's a decent thing. Like, just keep buying. It's a decent strategy that I think works for most people. But if you're trying to get to over $10 million in wealth, it's not the strategy. It just simply isn't. And so once I started realizing the flaw of some of the, one size fits all, like, types of solutions that people put out there, I realized, okay, the better approach is to say, hey, if you're here and you want to go here, here's the strategy, right? And so I think it's a little more nuanced. And the analogy I give in the wealth ladder is just like a fitness coach would give different advice to an obese person versus, like, a well-trained athlete who's trying to get to the next level. The same thing's true with our financial advice. And so I think when you're talking about allocation, when you're talking about any of these things, I think it's true. This is just outside the wealth ladder. I think we should be doing more thinking about, how is this different for different people, and is there a framework we can use for that? So, yeah.
Yeah, I like that a lot. We have the different kind of, like, stereotypes that are out there about Gen Z or millennials or anything like that. Are there any stereotypes that kind of tick a nerve, or, like, you feel like, oh, everybody says they do this thing and it should really be the other way?
I think I wasn't a stereotype, but more as, like, a data issue I had problems with. It was like, millennials are the poorest generation ever, this and that, and it looks terrible. And at the time, with the snapshot data they had, it did look like millennials were far behind on all these metrics. And they've since caught up a lot, because a lot of some wealth's been passed down, like, they've gotten better jobs, incomes have improved. Does that mean every millennial is doing well? No, I think there's still very big distributional impacts where people in the bottom 20% are doing worse than any generation ever, but the rest of the cohort's doing okay now, and so it's actually caught up a bit. So I think sometimes it's, using data is great for making arguments, and I love using it, but sometimes there's lags, there's weird things like, well, at the same age this time they should have had this. It's like, well, we have certain things that boomers didn't have, but then boomers, had cheaper housing, right? So there's debates to be had about what's better or worse. And I'm not here to say, oh, this one's better, that one's worse. It's more about, like, hey, every generation's different. And I get annoyed when it's like, oh, look, they aren't at the same spot on this particular metric. Like, that's true, but we also have these other things which I think are better than prior generations had. So you kind of need to balance it a little bit. So
Those kind of metrics, or focusing on negative details, seems very discouraging, versus kind of what sounds like you're talking about is more empowering. Like, what can we do to level up our wealth, versus just, oh, our wealth is in this spot or that spot, so we're worse off, kind of thing.
yeah, exactly. And so it's trying to figure out, like, what's the thing that, try and look at this optimistically, and like there's usually more to the story than a simple headline. Like, I do think there are a lot of things that millennials have worse off than prior generations, but there's also some things that we have better off. Like, our technology's better, like our healthcare is better, even though the US healthcare system is still very messed up. And on it, people, like, there's this argument that like healthcare prices are going up over time. If you actually think about it, like, healthcare prices are coming down. I know you're like, what do you mean that it's coming down? Go back 100 years, like the richest man in the world, like if his kid could have died of polio, that's something that we can easily prevent now. So is the price of polio was infinite? Now it's not, right? And you do this across a lot of other things. Cancer treatments are getting better, etc. You do all these things, and now like all these really terrible outcomes that no amount of money could have solved is now very solvable for a finite countable amount of money that many people can afford. That's prices coming down on the long run. Of course, in the interim, it sucks that we do have to pay. You go in for a doctor's visit, and it's ridiculous how like certain things are definitely going up, right? That make no sense. But in aggregate, I think prices are actually coming down, and that's a good thing. That's why people are generally healthier and living longer, right? Even like Ozempic, that's going to be a drug that's going to help save so many people in so many different ways from having less healthy lives, right? So that's an example of there was no solution for this. Now there is one. Whether it's the right solution is debatable on its own. So
I love that. No, that's a great way to look at it. So we kind of talked about maybe some of the mindset stuff. Are there particular things now that people do that are very popular to do from a personal finance standpoint? Different ways of living that are really hindering their ability to get from level 1 to level 2 or level 2 to level 3 or anything like that?
yeah, so once again, for every level, the mindset changes are different, right? If you're trying to go from level 4 to level 5, and level 4 is, and I should just walk through the levels very quickly. Level
Yep.
1 is less than $10,000 in wealth. Level 2 is $10,000 to $100,000 in wealth. Level 3 is $100,000 to $1 million in wealth. Level 4 is $1 million to $10 million in wealth. Level 5 is $10 million to $100 million in wealth, and level 6 is over $100 million in wealth. The nice thing about this system is once you know one of the levels, you can figure out all the rest because you either multiply by 10 to move up a level or you divide by 10 to move down. So if you're like, oh, level 3 is 100K to a million, that's, by the way, that's like the middle class in the US. That's about 40% of US households. So that truly is like the middle class. That's how much wealth they have. Once you know that, you can kind of jump around. So your question in terms of mindset, how does the mindset need to change? I think it depends where your starting level is. If we want to talk about people in level 1, I think the big mindset change there is like, what do I need to do to eventually raise my income to get out of the situation I'm in? Now, of course, that is not something that's going to happen overnight. It's like if you're already working, let's say 2 jobs trying to get ahead, like you're maybe saving some and that's helping you kind of move that forward, but you're going to have to find a way. Does that mean education? Does that mean you learn a new skill? It might take years before that starts to pay off, but you need to find a way to increase your income so that you can start saving more and then get out of that level, right? That's the key. And even in level 1, like there's a lot of, if you're in a really rough circumstance, you might have to go above and beyond, do things that it's going to sound very like hustle culture type response. But like when you're in, the catchphrase for level 1 in the book is atypical results require atypical actions, because if you are in a very bad situation, you have to go above and beyond to get out of it. There's no way around it. I wish I could sugarcoat it and say, oh no, all you got to do is just believe in yourself and stuff like that. Like that's not enough. I think like just believing in yourself, like that's great, but you need to go above and beyond to kind of get there. And unfortunately, that's not true in every level. I don't think that the difference getting from level 4 to level 5 is that type of, oh, you need to go above and beyond. I think in every level, the strategy changes depending on where you're trying to go. So, and I can get into that a little bit more.
Yeah, I would love it. This is great stuff so far.
Yeah. So, for example, let's talk about level 4 a little bit, because I think this is the best example of why strategy matters. So, the strategy to get into level 4, which is about $1 million to $10 million in wealth in general, is have a pretty good income, save for a lot of years, invest that money, and if you do it for a long enough time, you'll get into level 4. I think that's generally the case. The income has to be pretty high, though. I think so. By the way, the average income, the median income of households in level 4 is about $200,000 a year. So it's a high income, right? This is a household. So this could be you and your partner, you by yourself, whatever. So that's a household income of about $200,000. That's the median. So we took everyone with $1 to $10 million in wealth, looked at all their incomes, sorted them, took the middle person basically, or middle households, it would be around 200K. So, and that's as of 2022, 2023, roughly. So just giving you an idea. So maybe it's changed slightly, but probably not too much. So given that, that's the strategy you get into level 4. You save that money, you invest it in the markets, you get there. By the way, the median age of the household in level 4 is 62. So this is not a 30-year-old that's in there. Less than 1% of households in level 4 are 30 or below. Most are older, right? So that's another thing. It takes time, right? There's no debate. The data shows this. But you're like, oh, I want to get to level 5, 10 million to 100 million. The strategy to get there is very different. The working a 9-to-5 W-2 income plus, investing in the market is just not going to get you there. The strategy is very different. And the strategy to get to level 5 is usually some form of entrepreneurship. Besides celebrities and athletes, entertainers, things like that, basically all the people in level 5 are some sort of entrepreneur. Obviously, I'm obviously excluding lotto winners. I'm excluding like inheritance. I'm excluding married into it. Like ignoring all those people, it's basically all entrepreneurs. It's business owners of some sort, whether they started their own business or they joined a startup very early and got a decent amount of equity, and then that business sold for a lot of money. So one of those things happened and got them into level 5 or level 6, right? And so as you can see, if we're just talking about strategy, the strategy to get into level 4 is very different than the strategy to get out of level 4. And that's like I think level 4 is I call it the no man's land of wealth, because once you're there, getting out is like, it's not impossible. It is very, very difficult to get out of level 4, which is not saying you need to get out of level 4. Level 4 is great. Like a lot of people get in there and then they coast. That's where Coast Fire got popular. It's like, hey, I've done enough. Now I can take my foot off the gas, maybe earn less money and go do something I love and just, be okay to not get to 10 million, not to keep, going after more money. And I think it's a very rational response. I think it's the right response, actually. But if you really are just gung-ho on building as much wealth as possible, that W-2 plus just investing in the stock market is probably not going to get you there,
Yeah, that's interesting. It kind of, you wonder how many people burn their chance to succeed in level 4 because they take too much risk in the stock market trying to get to level 5, not realizing that it's kind of a different game you should be playing.
Yeah, it's just really tough. Like, I mean, of course, like Warren Buffett could have done it because he was compounding at 20% a year. I'm assuming, let's just do the math on this real quick. Like, let's say you just hit $1 million, which is already a feat in itself. It's not easy to do. Very few people ever do it, right? So once again, level 4 is going to be, let's say, about 18% of the US, right? The top 2% is level 5 and 6, roughly. Remember, these are approximated. The actual numbers are in the book, but 18%. So you're already at the top 20% is level 4, 5, 6. It's already hard to get there. Let's say you got $1 million. You're saving $100,000 a year. This is after tax money. It's a lot of money to save, right? And you're growing your portfolio 5% a year. Let's assume that's inflation adjusted, right? So it's a decent return, right? Not super high, but decent, right? It would still take you 23 years before you hit 10 million if you're doing that. Start with $1 million, add 100K a year, grow it at 5% a year, 23 years before you get to 10 million. Let's say you're like, oh, Nick, I'm going to save more than that. I'm going to save $300,000. Remember, this is after tax money. That's a lot of money you're saving. It still takes you 17 years to get to 10 million. With the same, start at $1 million, add 300K a year, do the 5% growth, it still takes you 17 years. So the math, once you get into level 4, is just very difficult because even saving 300K a year, you got to be making at least double that, if not more, it's crazy when you look at the numbers. Like, there's just no way to get there, right? You have to have this massive exit. So once you start doing the math on this stuff, you start to realize oh, wow, yeah, you really need to take a different strategy, because even saving really good money and compounding your money for many decades still may not be enough, or it just takes a long time to get there.
Yeah, that's crazy. So what about level 3 to level 4? What are the unique challenges for level 3?
So level 3, that's going to be your 100,000 to $1 million. That's your typical middle class. I think that these levels are much more similar than they seem in terms of lifestyle. Like, there is a difference. Like, the people in level 4 generally live a slightly fancier lifestyle, but it's not as different as people think. I think a lot of it is status and, buying expensive stuff to make yourself seem like you're much richer than necessary. Like, you're on the same plane. Like, I'm telling you, people in level 4 are generally not flying private. Maybe once you get to the very high end, 8 to 10 million, you can do it once a year maybe, but no one in level 4 is regularly flying private, right? It's just you can't afford it. It's too expensive. So you start doing the math on this stuff, and it's like you're in the same airplane, you're just in a different seat, right? You're probably maybe in different neighborhoods, you have a slightly nicer house, but it's not like both of them probably own a home if you're in level 3 or level 4. Like, it's very common home ownership in both levels. But in terms of like what's the mistakes that prevent people from level 3 getting into level 4, my guess is it's level 3 households. And I have some data that shows this as well. It's level 3 households that are spending more to look more like level 4 households. And as a result of that, because they're spending so much higher, they aren't saving as much to actually go into level 4. So not everyone in level 4 is, trying to show status and be flashy and all that, but people, because they're so similar, that's how they try to differentiate themselves, right? And so the big thing that I notice in the data is the difference between the households that make it to level 4 from level 3 versus those that just stay in level 3. There's two differences. One, the starting income tends to be a little higher for those that go into level 4. So that's income's a piece of it, but also spending. Like these households, like, the households in level 3 that stay in level 3 end up spending a lot more than those that are in level 3 that go to level 4. So even though their incomes might be quite different, their spending is very similar. And those types of things end up holding them back and preventing them from getting to the next wealth level. Whether they want to get to level 4 or not is completely up to them. I don't really care. It's whatever you want. But I think overspending on big ticket items, like that's where it does happen. So I'm not going to say cutting your spending is not a way to get wealthy. I don't generally recommend that. It's mostly through your income, but there are times when it can, put a little bit of a brake on your growth rate in terms of your wealth building.
Was there anything in the data? I'd be shocked actually if the data was this granular, but was it like boats taking out the big progress?
No, they don't show that. All you can really see is just general spending, and unfortunately that's not the best metric, right? I wish I could look into every single thing and like, that there's always the joke about the boat. The best day in the boat owner's life is the day they buy the boat and the day they sell the boat, right? So it's like, that's the joke I've heard before. But I have no clue what causes it. I think we don't have enough granular data, and I'm just saying in general, it's probably because once again, level 3 and level 4 aren't that different. Like that's why I classify level 3 as the middle class and level 4 is the upper middle class. I know you're gonna say, well, Nick, you're saying only someone with $5 million is upper middle class. Well, in a lot of the U.S., yes. In parts of the U.S., no. It depends where you are. Like if you're in a more rural or low-cost area, $5 million is a lot, and you're definitely upper class. But for most of like the big cities where a lot of people are, you can really get nice stuff, but your lifestyle is going to be very similar. You're still getting on normal planes. You're not flying private. You don't have a yacht. You don't, maybe you can pay for, maids or cooking services possibly, but even then it's like I don't think that's really that much of a differentiator in terms of lifestyle. A little bit, but not too much. So
gotcha. That's interesting. So what about level 2? Talk to us about level 2. What were the big takeaways there? How do their challenges or opportunities change from all the other levels?
I think level 2, so that's $10,000 to $100,000. I think the big differentiator there is education of some sort. Now, like what gets people into those next levels? You can imagine, most people start in level 1. Some technically, like I would consider myself starting in level 2, though I had less than $10,000. I had like $1,000 to my name after I signed my signing bonus for my first job and left college and everything. So I technically was in level 1, but I had an education, I had a family I could fall back on. So through those associations, I would say I started in level 2. And so you can imagine that the leg up I had over other people just from those things, right? Like I already had a higher trajectory because of the education, because of all these other things that ended up helping me grow my income, all these other things. So I think the thing is like, if you're in level 2, the big differentiator to get out of there, you're either a temporary visitor because you have a good income and you'll just give you time and you'll get out of there. That's one piece of it. I think another piece of it is like, okay, well, what's the trajectory of your career looking like and how can you raise your income or your long-term income such that that trajectory changes and it's easier to get out of level 2. So once again, all this stuff comes back to income, and I talk about income so much because, we hear all the whole, cut your spending, don't, buy lattes, avocado toast, all these silly things. And like, there's no data that I think supports this at all. I don't think spending is the culprit. Yes, you can have You have anecdotes about, well, I know this guy that spends too much, or I know that person, right? That's fine. I'm not saying there aren't those people, but in the aggregate data, wealth and income are so correlated, it's crazy, right? Like, I just love reading. Like, I have a table in the second chapter in the Wealth Ladder, which basically talks about the median U.S. household income in each level, and I'll just read that for you now. So I'm just going to read the levels. I'm not going to say the wealth. So level 1, the median household income is $32,000. Level 2, it's $48,000. Level 3, it's $83,000. Level 4, it's about $200,000. Level 5, it's $724,000. And level 6, it's $4.3 million. And so, by the way, a lot of this is like a flywheel. Once you have wealth, that can build income, and then it's vice versa. Like, if you have $100 million and you're earning 4% a year, that's $4 million a year in income, right? And so they're earning 4.3 million. That's the median household income. So you can see that, like, it does start to just creep up that way pretty easily. But the point of that is, like, these two things are so connected, income and wealth, that it's like the strongest relationship I found in all of personal finance and investing. Like, I cannot find a better data set that better predicts someone's income. And if you look at the data, like, spending does go up as wealth goes up and as income goes up. They both increase, but spending increases at a slower rate than income. And what that gap, that delta, that growing delta, that's people saving money and investing it and building wealth. That's it. I mean, we can sit here and talk about people need to cut their spending all you want, but at the end of the day, the delta comes from income, and that's why I tell people to focus on income. And that doesn't mean you're gonna, you can't just wave a magic wand, your income goes up. You have to, like, really spend a lot of time and work at something and figure out some sort of way of doing that, whether that's a new job, whether that's a side hustle. Like, there's a lot of different ways, and I talk about some of that in the book. But I think that's the thing people need to focus on.
It's actually really profound that you found such a strong link. It reminds me of Michael Mobison's work. He talks about, for free cash flow growth, earnings growth for a business, the biggest driver of that is their revenue growth. It's that top line. And so you're saying it's a similar thing for people. It's that very top, how much money is coming in, that helps you more so than even if you can cut expenses to the bone. The majority of people are finding that it's that income. So yeah, I find that's really fascinating.
Yeah, thanks for that.
So can we talk about some of the kind of takeaways? I know obviously people should go check out the book. It's called The Wealth Ladder: Proven Strategies for Every Step of Your Financial Life. Can you tease like a kind of like a side hustle, some of that piece that you talked about that people can do to tangibly increase the income?
Yeah, there's side hustles, and then there's something I like to call, like, the leverage framework, which is not mine. It came from Naval Ravikant. But the idea behind leverage is that there are these 4 things you can do to create leverage, which makes it easier to raise your income. And so one of them is using labor. I will get into all these. One is using capital, or your money or someone else's money. One is using content, and then one is using code. And so, like, labor is the simplest one. That's like, I have a business and I employ other people to work for me on that business, and they generate more revenue than what I pay them. And so that's how I earn money as a business owner, right? Everyone kind of understands that one. It's very straightforward. Capital is like, hey, I borrow money from someone, or I take money from investors. I invest it in a way that creates a greater return than what I'm paying for the money, whether that's the fees I'm charging or the interest I'm paying to a bank, etc. And then I use that to create my leverage, right, which helps increase my income, etc. Content, very straightforward. That's kind of what I do. I create content. I try and write helpful pieces on personal finance investing. I put it out there, and it can keep earning me money, whether it's ads on a blog post, whether it's a book that's sold, etc. And that's the type of thing where my time is being divorced. In all these cases, your time is being divorced from the act of producing income. Because for most people around the world, and myself included, I still have a full-time job, by the way. So I'm doing this. I'm in the trenches working at a wealth management firm doing all that. But I do this stuff on the side. This is my side hustle, right? But the idea is that, you work 9 to 5 and you get paid for those hours, right, etc. These are systems you can create where you're getting paid outside of those hours, right? They say getting paid while you sleep or whatever. I mean, that's an analogy that's used, but it doesn't have to be while you're sleeping. It can be at any point, right? And so I think that's the idea, is to create one of these leverage systems, and using code is the same way. You create a computer program or an app or something that people are using over time, that you can keep making money from that over time. And with AI solutions, it's much easier to get into, like, you can get into coding, and if you have a good idea now with these solutions, you can kind of create maybe an initial version of an app or something. And so it's much easier to get there. So I think you're going to start to see much more idea people going out and creating apps without having to hire a bunch of engineers or take as much risk. Maybe they create the app initially, it works, and then they hire someone. Like, there's a lot more that we're going to see because of AI that's going to really help, I think, the code environment. So those are just 4 examples. In terms of side hustles, I've heard people do all sorts of side hustles. Like, my stepbrother makes diesel engine, like, heaters, like heating, like, I don't know if they're lamps, I don't know what they do, they heat things, but they use diesel, and he 3D prints them. He's a 3D printer. He prints them and sells them on the internet, ships them out, makes good side money doing it, right? I've heard of people, like, in the book I talk about there's 2 side hustles I talk about. This is in Maryland. I think there's a bridge, Chesapeake Bay Bridge. It's one of the scariest bridges in the world. People are so scared of it. Like, people actually, people have crashed and stuff happened. So people are so scared of it. A guy's decided to open a van service where he drives you over the bridge. He makes his revenues 6 figures a year driving people over a bridge. That's how he's had thousands of customers, right? It's like, I'm not saying that you're going to have a crazy bridge, you're going to have this, but, like, there are so many ways to make money, and it's not easy, but you have to start going and doing something, and you're going to figure out what works, what doesn't. Okay, that was a waste of time. That wasn't. Read Reddit. Reddit talks about different side hustles. Like, there's whole communities that talk about this stuff. And you got to start somewhere, and then you build it. Like, in my case, I did everything wrong. Like, I spent 3 years writing. I didn't make a single dollar. And then finally in 2020, I started in 2017. In 2020, I built up enough of an audience. I started running web ads and started making some money on it. So did ad partnerships. I now have a few books, right? So it's taken me a long time. Been doing this for 9 years. And the first 3 years I made $0. I just did it because I love it. And I still love it. And I'm going to keep doing it regardless of the money because I enjoy it, So I think that's the thing, is, like, follow your interest a little bit and see where that leads you, and then kind of keep working from there.
I love that. That's great advice, and funny to hear those examples of problems being solved and people will pay money for problems. So that's really, really great. Any last words? Maybe somebody's super inspired by what you do. Maybe they're big fans of Nick Maggiulli, feel like think similarly to you, and maybe they have been kind of grinding on a side hustle, but just haven't seen any results yet. Could you speak to that person and give them a word of encouragement or advice as it relates to continuing to grind on a side hustle?
Yeah, I will say 2 things. I will say, either A, you haven't been doing it long enough, but if you haven't been doing it that long, you should be getting some sort of positive reinforcement. Doesn't mean you've made it yet, but you should be like, okay, I've had some positive break. If you're seeing nothing positive from this, you probably need to change. So that's what I would say. If you've seen some positive reinforcement, keep going. If you haven't seen much of anything, then you probably need to reassess whether this makes sense, and you maybe need to change it up, try something different. That's what I would say. Because I had some positive, even though I wasn't making money early, I had positive reinforcement, and more people following along, more people commenting, things like that. So that said, hey, that you have something here, like, keep going at it, and it can become something. So I never thought I'd write a book, let alone 2 books. And so you can surprise yourself if you really work at something, for a long time. So that's what I would say.
That's awesome. Perfect. Well, once again, check out the books. Just Keep Buying is the first one. And then this one, The Wealth Ladder, Proven Strategies for Every Step of Your Financial Life. Nick, thanks so much for being generous with your time and your advice. Where else can people check you out, see what the work that you're doing? You have a great newsletter as well, by the way.
I appreciate that. Yeah, you can find my websites of dollarsandData.com, or you feel free to DM me. On Twitter, I'm under Dollars and Data. On Instagram, it's Nick Maggiulli, just my full name. And then on LinkedIn, it's Nick Maggiulli. So you can find me any one of those places. Send me a DM. I respond to every DM, and I will respond to all of them. Just give me time. I promise I'll get there. Yeah. So thank you. Thank you for your time. Appreciate it.
That is going to wrap us up. Remember, invest with a margin of safety, emphasis on the safety. We will talk to you next time. Peace.